I want to ask you a question, and I want you to be genuinely honest with yourself when you answer it. How many investment accounts do you currently have money in? Most people I talk to have a 401k through their employer, maybe an IRA they opened at some point, possibly a regular brokerage account if they have been investing for a while. And if you are in that group, you feel reasonably on top of your financial life. You know the accounts exist, you know roughly what they do, and you feel like you are using the system correctly. Here is what I need to tell you directly. There is almost certainly a third account type sitting in your employee benefits package or available to you through your health insurance that is more powerful from a tax perspective than your 401k and your IRA combined. And the overwhelming majority of people who have access to it are either not using it at all or using it in the most limited, least strategic way possible, which is roughly like owning a Swiss Army knife and only ever using it to open envelopes. I'm talking about the health savings account, the HSA. And today I want to show you exactly why I think it is the single most powerful tax-advantaged account the US government currently offers to regular people, how the advanced strategy around it can potentially generate $400,000 in completely tax-free wealth over a working career, and why the way most people use it is leaving an enormous amount of money permanently on the table. I have been using an HSA strategically for several years now, and the more I understand about how this account actually works at a deep level, the more I genuinely cannot believe it does not get more attention than it does. By the end of this video, I think you are going to feel the same way. Subscribe right now if you are new here. Let's get into this. I want to start with the basics because I know some of you watching this have a general sense of what an HSA is, but have never had anyone explain the full mechanics clearly. And the full mechanics are where the power is, so I do not want to skip over them. A health savings account is a tax-advantaged savings and investment account specifically designed for healthcare expenses. To be eligible to open and contribute to one, you need to be enrolled in what is called a high-deductible health plan, or HDHP. That is a health insurance plan with a higher deductible than a traditional plan, meaning you pay more out of pocket before the insurance kicks in but with lower monthly premiums. The IRS sets specific deductible thresholds that qualify a plan as an HDHP, and those numbers adjust slightly each year. In 2026, the contribution limits for an HSA are approximately $4,300 for an individual and $8,550 for a family. Those numbers go up slightly most years with inflation adjustments. Your employer may contribute some amount to your HSA as well, which is essentially free money on top of your own contributions. Now here is where I want to spend real time, because this is the part that makes the HSA genuinely extraordinary compared to every other tax-advantaged account you have access to. Every other investment account the government offers you involves a tax benefit on one end of the transaction. Your traditional 401k and traditional IRA give you a tax deduction when you contribute, meaning you pay taxes later when you withdraw. Your Roth 401k and Roth IRA give you no deduction up front, but your withdrawals in retirement are completely tax-free. Every account is either tax-advantaged on the way in or tax-advantaged on the way out. The HSA is the only account in existence that is tax-advantaged on both ends simultaneously and also tax-free in between. Let me walk through all three benefits because each one matters. Benefit 1, your contributions are tax-deductible. Every dollar you put into your HSA reduces your taxable income for that year dollar for dollar. If you contribute $4,300 and you are in the 22% federal tax bracket, you just saved approximately $946 in federal taxes immediately, just from making the contribution. That money did not go to the IRS. It went into your account. Benefit 2, your money grows completely tax-free inside the account. Once your HSA balance exceeds a certain threshold, typically around $1,000 to $2,000 depending on your HSA provider, you can invest the excess in mutual funds and ETFs just like you would in a brokerage account. Those investments grow without any capital gains tax, without any dividend tax, without any annual tax drag of any kind. The compounding happens in a completely tax-free environment for as long as the money stays in the account. Benefit 3, withdrawals for qualified medical expenses are completely tax-free, not tax-deferred, tax-free. You put the money in tax-free, it grew tax-free, you take it out tax-free. If you use it for qualified medical expenses, the government never touches that money at any point in its entire journey through your financial life. No other account does all three of these things simultaneously. The 401k does one. The Roth IRA does two if you count the growth and the withdrawal together. The HSA does all three independently and simultaneously. That is what makes it genuinely in a category of its own from a tax efficiency perspective. Now I want to explain the advanced strategy because the way most people use their HSA captures maybe 20% of its actual potential, and I want to show you what the other 80% looks like. Most people use their HSA exactly like a healthcare checking account. Money goes in with the tax deduction, sits in the account earning minimal interest, and gets spent on medical expenses throughout the year. Copays, prescriptions, dental work, vision care. The account balance stays relatively low because it gets spent down regularly. The investment feature never gets activated. The triple tax benefit is only partially captured because the growth phase, which is where the real power is, never really happens. The advanced strategy looks completely different, and it hinges on one specific insight that changes everything about how you think about this account. You do not have to use your HSA money for medical expenses in the year those expenses occur. The IRS has no rule requiring same-year reimbursement. You can pay a qualified medical expense out of pocket today, save the receipt, and reimburse yourself from your HSA 5 years from now, or 10 years from now, or 20 years from now. There is no statute of limitations on reimbursement, as long as the expense occurred after you opened the HSA account, and as long as you have documentation. Let me show you why this single fact is the key that unlocks the full power of the HSA. Imagine you open an HSA today. Every year you contribute the maximum $4,300 as an individual. Instead of using the HSA money to pay your medical expenses, you pay those expenses out of pocket from your regular checking account. You keep every single receipt, every explanation of benefits, every medical bill you pay. You invest the entire HSA balance in a low-cost S&P 500 index fund inside the account, and you leave it completely untouched. Year after year, the contributions go in, the investments compound, and the receipts accumulate in a folder or a digital file somewhere. The HSA balance grows not just from contributions, but from investment returns on a growing balance in a completely tax-free environment. Now here is the math that I find genuinely jaw-dropping. If you contribute $4,300 per year to an HSA starting at age 30, invested in an S&P 500 index fund earning an average of 8% annually, and never touch the money for 30 years, your HSA balance at age 60 is approximately $530,000. Every single dollar of that $530,000 went in tax-free. Every dollar of growth happened tax-free. And every dollar can come out completely tax-free as long as you have qualifying medical expenses to match against it. And here is the thing about qualifying medical expenses over a 30-year period: you will have them. Most people accumulate tens of thousands of dollars in legitimate qualifying medical expenses over 3 decades of life. Dental work, vision care, prescription medications, copays, physical therapy. The list of what qualifies as an HSA-eligible medical expense is extensive. As long as you have kept receipts and documentation for expenses that occurred after your HSA was opened, you can reimburse yourself tax-free at any point. So the advanced strategy user at age 60 potentially has $530,000 in their HSA, a folder full of 30 years of medical receipts representing tens of thousands of dollars in reimbursable expenses, and the ability to withdraw that money completely tax-free to fund retirement expenses. It is the closest thing to a legal tax elimination strategy that exists for ordinary people within the current U.S. tax code. Now I want to be honest about the realistic version of this, because I do not want to paint a picture that is accurate on paper but impossible in practice for most people. Full advanced strategy requires you to have enough cash flow to pay medical expenses out of pocket without using the HSA. For people in their early financial journey who are living on a tight budget, that might not be realistic in the early years. If you have a significant unexpected medical expense and you genuinely cannot cover it from your regular accounts without financial hardship, use the HSA. That is exactly what it is there for. The strategy scales with your financial situation. Even a partial version of this strategy, where you pay smaller routine medical expenses out of pocket and only use the HSA for larger unexpected costs, captures significantly more value than the standard spend-it-down approach. And as your financial position strengthens over time, you can gradually shift toward the full strategy where the HSA becomes a pure investment vehicle. The receipt-keeping habit is genuinely important, and I want to spend a minute on it because I think it is the part people are most likely to skip, and also the part that matters most for executing the strategy correctly. I keep a dedicated folder, both physical and digital, for every single HSA-eligible medical expense I pay out of pocket. The digital folder is backed up in 2 places. Each receipt has the date, the amount, the provider, and a note about what it was for. I treat these receipts as financial documents with real monetary value because they are. Each $300 dental bill I pay out of pocket today is a $300 tax-free withdrawal I can make from my HSA at any point in the future. That receipt is worth $300 plus the tax benefit of the withdrawal. I treat it accordingly. The IRS does not require you to submit these receipts proactively. They need to exist and be available if you are ever audited, but they sit in your folder until you choose to use them. The record-keeping burden is genuinely not heavy if you build the habit from the beginning. It is a 15-second task every time you pay a medical expense out of pocket. Date, amount, provider, purpose. That is the entire process. I also want to talk about what happens to your HSA money at age 65, because I think a lot of people do not know this, and it is an important part of the complete picture. At age 65, the HSA essentially becomes a second traditional IRA for non-medical expenses. You can withdraw the money for any purpose, not just medical expenses, and you simply pay ordinary income tax on the withdrawal the same way you would on a traditional 401k or IRA withdrawal. The penalty for non-medical withdrawals before age 65 is significant, 20% on top of regular income tax, which is why you want to be confident you have qualifying medical expenses to match before doing large early withdrawals. But at 65, that restriction lifts entirely. What this means in practice is that in the worst-case scenario where you somehow reach retirement age with more HSA money than you have qualifying medical expenses to match, you still have a very valuable account. You just pay regular income tax on the excess the way you would on any other retirement account. There is no scenario where having a large HSA balance is a bad outcome. The worst case is that it performs like a traditional IRA. The best case is that it performs like a tax-free retirement account with decades of compound growth behind it. Now I want to walk through the specific steps I took to set up my own HSA strategy, because I think concrete implementation details are more useful than abstract principles. Step 1 was verifying my health insurance eligibility. Not all health plans qualify for HSA contributions. You need to be enrolled in an HDHP. If you are not sure whether your current plan qualifies, the plan documents will specify it or your HR department can confirm it in about 2 minutes. If your employer offers multiple health plan options, it is worth doing the math on whether switching to the HDHP makes financial sense for your situation. For many relatively healthy people, the lower premiums of the HDHP plus the HSA contribution opportunity more than compensate for the higher deductible. Step 2 was choosing the right HSA provider. Here is something most people do not know. If your employer offers an HSA, you do not have to use the provider they default you to. Many employer-sponsored HSAs have high fees, limited investment options, or both. I did research on this and found a provider with genuinely low fees and access to a broad range of low-cost index funds. There are a handful of consistently well-regarded HSA providers that offer Fidelity and Vanguard fund access with minimal fees. The annual fee difference between a good and a mediocre HSA provider on a growing balance over 20 years is not trivial. Spend an hour researching this, it is worth it. Step 3 was setting the investment threshold as low as possible. Most HSA providers require you to maintain a minimum cash balance before you can invest the remainder. That threshold is often $1,000 or $2,000. I set mine to invest everything above the minimum automatically into my chosen index fund. The money does not sit in cash waiting to be deployed. It goes to work immediately. Step 4 was automating the maximum contribution. I set up an automatic transfer for the maximum annual contribution split across 12 months. The contribution is automated on the same schedule as my other investment contributions. It is non-negotiable and it does not require a monthly decision. Step 5 was starting the receipt folder. I picked a dedicated location for medical receipts both physically and digitally, and I have added every qualifying expense to it consistently since opening the account. The folder is already meaningful in terms of reimbursable value, and it grows every year. I want to address one question I get consistently when I talk about the HSA strategy, because I think it trips people up and causes them to delay getting started. The question is, what if I switch jobs or change health plans and lose access to the HDHP? What happens to the HSA money? The answer is nothing bad. Your existing HSA balance remains yours permanently regardless of what health plan you are enrolled in going forward. You simply cannot make new contributions in years when you are not enrolled in an HDHP. But the existing balance continues to grow tax-free, continues to be available for qualified medical expense reimbursements tax-free, and continues to behave exactly as described. The account does not disappear or get penalized when your insurance situation changes. You just pause contributions during non-HDHP years and resume them if and when you return to an eligible plan. This portability is one of the HSA's underappreciated features. Unlike a flexible spending account, which is use it or lose it within the calendar year, your HSA balance rolls over indefinitely. There is no forfeiture, there is no deadline. The money is yours and it stays yours and it keeps compounding until you choose to use it. Let me give you the 3 things I want you to do this week to start capturing this. First, check whether your current health insurance plan is an HDHP and therefore HSA eligible. If you are not sure, look at your plan documents or ask HR. This takes 5 minutes, and it is the threshold question for everything else. Second, if you are eligible and not yet contributing, open an HSA account this week. If your employer offers a sponsored option, start there and evaluate whether the investment options and fees are competitive. If they are not, look at the well-regarded independent providers and see whether a rollover makes sense. Third, start the receipt folder today. Even if you just opened your HSA and your balance is minimal, the receipt-keeping habit is worth building immediately. Every qualifying medical expense you pay out of pocket from this point forward is a future tax-free withdrawal. Treat every receipt as a financial document with real value because that is exactly what it is. The HSA is not a complicated account. It is not a loophole that is going to get closed tomorrow. It is a straightforward, fully legal government-designed savings and investment vehicle that is hiding in plain sight inside most employer benefits packages. The people who understand it deeply and use it strategically over a full working career are going to arrive at retirement with a source of completely tax-free wealth that their peers, who treated the same account as a healthcare checking account, will not have. The difference is not income. It is not investment sophistication. It is understanding the tool clearly enough to use all of it instead of just the obvious part. Hit subscribe if you want to keep building this kind of knowledge with me every week. Share this with someone who has an HSA they are not using strategically, because this specific conversation could genuinely be worth hundreds of thousands of dollars to them over their lifetime. This is Dave. I will see you in the next one.